from New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, the Treasury sell-off resumes as September gets underway ahead of the final inflation print before the Fed's meeting, while corporate bond issuance roars back to life. We begin with the big issue. Wake me up when September ends.
The Fed's on ice.
Probably pause.
Press the pause button.
The pause in September.
Pause and wait a little bit.
Unless you got something very significant on CPI, I think they're not going in September.
CPI next week can definitely change it.
I think the continuation of the drop feels the most likely scenario in terms of inflation.
This year, what we've seen is basically a very strong recovery.
If you look at the labor market, there is an argument to go stronger, and there is an argument to pause.
These cracks are forming.
If you look at claims, you'd think the economy is on fire.
We'll have to see how the data plays out.
What's going to happen beyond September?
It's hard to say that there is smooth sailing ahead.
We're going to get waves of inflation for the next 2 years.
This is a very complicated time for the Fed.
The Fed's job now is much more complicated.
Joining us now, I'm thrilled to say we have BlackRock's Gargi Chaudhuri and George Bory of Allspring, both on set, which is a particular delight. And Gargi, I want to start with you. When you weigh together all of the data, especially that we got this week, how close is this Fed to the finish line?
Sure, Katie. Good afternoon. It's great to be here. Thank you for having us. I think they're very close to being done, or at least they're close to, at the next FOMC meeting, suggesting that rates are restrictive, as they have done before, and suggesting that all options still remain on the table while they have a hawkish pause, is what I'm going to say. So no rate hikes for now, given what we saw in the wages data, in the jobs data, and what I think is going to be another moderating inflation print.
Well, let's talk about what the bigger risk here is, George. As we get closer to that finish line, there's a really interesting tweet from Bob Elliott of Unlimited this week, writing that the Fed, the ECB, the BOE, RBA, and the Bank of Canada all now look comfortable that they have done enough. Stopping their tightening before inflation is durably back to mandate may end up being the bigger mistake than being late to tightening in the first place. At this juncture, is the risk of over-tightening or not doing enough bigger in your mind?
Well, again, thanks for having us on as well. The risk at this juncture is really under-tightening. You know, the growth statistics look pretty good. As Gargi mentioned, sort of the hawkish pause seems like kind of the right decision at this point. And it's important to remember that in August, the Fed did a very good job of recalibrating expectations by allowing yields to go up, to reiterate that sort of higher for longer mantra. And so they've created a lot of optionality for themselves. So they can sit, watch data. They may not be ultimately done in the rate hiking cycle, but they're much closer. They're very close to the end. And we would agree that we are very close to the end, and that it's really about under-tightening at this point rather than over-tightening.
And of course, we'll get a big clue on where they are in that journey next week when we get those inflation figures. But actually, before the cameras turned on, we were talking about the sell-off that we've seen this summer when it comes to the Treasury market, particularly in the long end. And I'd love to talk about that a little bit because, Gargi, if you dissect this sell-off, that big rise that we saw, particularly at the long end of the curve, what was driving that?
Yeah, so we think back all the way to August 1st, which feels definitely more than just 5 weeks ago. We had a few events that came within the span of a week. We had the downgrade, we had the news of the deficit and all of the additional supply, which I think was obviously known by the market, but seeing those numbers all together. And then we had the yield curve control tweaking by the Bank of Japan. All of that in a period of time when the growth was immensely strong. It came at the backdrop of softening inflation, but what the market paid attention to actually was the strength in growth. That's what led to the steepening, and I would argue that we probably will continue to see some more steepening in the yield curve. I think there's more term premium that's left to come back in the 10, 20, 30-year part of the curve. But what looks very attractive now is actually the belly of the curve. So really focusing focusing on that 3 to 7 year part is where I think investors should be focused on as they're looking at the fixed income markets.
Well, you brought up this steepening, and actually we had an interesting conversation with Stephen Major from HSBC earlier today. Let's take a listen to that.
I've got much more comfortable with just outright long of 10-year plus, rather than trying to play anything fancy with the curve. If you start buying 2s versus 10s and play a steepener, you've got too much carry to overcome. And so the strategy favors taking duration over yield curve exposure right now.
So I think that's an interesting point. If you listen to what Stephen's saying, that basically rather trying to play anything fancy with the curve, if you think about buying 2s versus 10s and playing the steepener, there's too much carry to overcome. Gargi, weigh in on that. Is it time to not get too fancy here, or do you think that there's actually some benefit in trying to play the steepener?
I think there is some benefit to try to play the steepener as long as you can outperform the forwards. I think more importantly, given when I see the amount of cash that's sitting in the sidelines and when I think about where investors can go between now and the end of the year, especially with the focus in mind that Q4 and perhaps even Q1 of 2024, we could see some softening in the data. Not to say that we'll see a recession, but just a softening from the tremendous growth picture that we've seen in the first, almost 3 quarters so far. In that case, why not own some fixed income? And where you should own it is the part that's yielding you something and also giving you just a little bit of duration. So 5 years is what we like the best. Of course, the steepener can make sense. That can be a bull steepener as well. Obviously, the previous one was the best steepener. But I definitely think these are levels where investors should be looking to get back to sort of, we're recommending IEI, which gives you that 3 to 7 year sector exposure.
Okay, so Gargi likes the belly. Stephen Major is outright long, 10 years plus. George, where do you fall on this curve?
Time horizon matters. So in the near term, playing for kind of steepeners certainly can make sense. If you're in the camp of a soft landing, then a steepener is exactly what you should be positioning yourself for. But it will be more bear than bull because of the softness of the landing and perhaps the appropriateness of rates and the fact that yields may have to go up a little bit. We also like the short to intermediate part of the curve, but the 2-year above 5% looks very attractive to us. It looks good as effectively a substitute for very front-end paper. It's just far enough out that you are buying some economic protection against a cyclical downdraft. And, there's sort of these expectations that there's a little bit of hawkishness priced in for now. If we get a softening in the data, just a little bit of softening, as Gargi mentioned, that would be enough, we think, to help anchor the 2-year, bring yields down, and produce a nice return as we wait for the broader macro story to clarify.
And if we do start to actually get Fed cuts next year, which is priced into this market, I would imagine when it comes to the 2-year, you would also get that price appreciation.
Absolutely. Anything soft to hard, sort of like a softening of growth to a hard landing would really benefit the 2-year part of the curve initially. So it's just enough duration in a portfolio to matter. You're well covered from a carry standpoint. And we do like incremental duration extensions out the curve, but from just a pure yield versus duration trade-off, that 2-year looks pretty attractive.
Well, Gargi, you brought up IEI, which of course tracks 3 to 7 year treasuries. What's amazing to me, if you look at TLT, which is 20-plus year treasuries, it's in the midst of a record drawdown. If you take the chart out, I believe it's down 4% or so on a total return basis. You look at the inflows into this product, I think, $15 billion year to date. That's the second most of any ETF, and I had to check many times. What's going on there? How do you explain that bid, even though it's been very painful to be at the long end of the curve right now?
It has been, and I think some of that, like we discussed, makes sense given some of the data evolution that we've seen. But also, look, there are different types of investors with different time horizons. There are pension funds that we are speaking to. There are insurance companies that I'm sure we're both speaking to that have been waiting for these 4.34-ish levels or even higher to get back into the market. And I think TLT tends to be one of the instruments of liquidity. It's one of the largest asset gatherers because it is also one of the most liquid financial instruments that we have. And I think that what we've seen more recently, though, especially in the month of August, is some of that inflow moving now to the front end. So we've seen investors moving away from the very long end into the short and intermediate part of the curve. And I wouldn't be surprised if we continue to see a little bit of that rotation. But again, remembering that there are different types of investors with different defeasance purposes that they use their liability matching for, and they might still need to use an instrument like a TLT or an LQD.
George, what do you think?
Well, if you think about the returns of a bond, it's income plus duration and your change in yields. So if you can isolate duration and sort of turn those two dials independently, you can really closely calibrate your portfolio. And as Gargi mentioned, big move into the front end over the course of this year, particularly into cash. As those investors start to add duration to their portfolio, perhaps a sort of a slug of long duration, again, is just enough to help sort of balance that yield plus duration so that your total return looking forward, over the next several years is going to be both positive, it should be real in terms of real returns, and hopefully, kind of generous for investors.
Well, definitely, many investors have that mindset because, again, you look at the flows into this product, it's been pretty amazing. And we only have about a minute left, but Gargi, we should probably talk a little bit about oil. We've been watching crude oil rally for weeks on end. You haven't really seen it be reflected when you look at break-even rates. Should inflation expectations be higher here?
In fact, inflation expectations are responding to a couple of things. Yes, oil prices, which generally move the front end more so, but also a general risk off that we've seen. What we've been telling investors to actually do is the name of your show, real yield. Real yields at above 2% are a screaming buy. I know screaming buy has been the topic du jour, but it's certainly a screaming buy across TIP or STIP. And if you combine those and sort of build yourself a portfolio of about 5 to 6 year duration at above 2% yield, that makes a lot of sense.
All right, guys, good place to end it on that real yield name drop. Really enjoyed this conversation. My thanks to Gargi Chaudhuri and George Bory. Thank you. Now, we do want to bring you some breaking news. Just crossing the terminal, Barclays preparing to cut hundreds of jobs as soon as next week. The firm looks to trim costs amid quieter markets. Of course, the lender is planning to dismiss about 5% of client-facing staff in the trading division, as well as some deal makers globally as part of the cuts. This is according to people familiar with the matter. We're going to continue to stay on top of that story and bring you details as we have them. Up next on Real Yield, though, it's the auction block where appetite is strong. Global debt markets bursting with new deals as September kicks off. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where the issuance this week was as hot as the weather. Here in the U.S., Tuesday was the busiest day in more than 3 years, with $36 billion of sales. Overall, it stands as the third busiest week of the year, with more than $55 billion in total. Digging deeper into the companies behind the sales rush, you had companies like BHP, Gilead, Philip Morris, John Deere, and Volkswagen all coming to the stage with offerings. And junk borrowers also flooding the market, making it the busiest week since early August. Barclays estimates that there will be up to $20 billion of new bond supply and up to $25 billion in leveraged loans for September, including the company Restaurant Brands. Meanwhile, Oaktree's Armen Panossian says we don't need to see a recession to see defaults tick up.
I would expect rates to stay higher for longer as well, because even with or without a recession, there is going to be an elevated default experience. I think that the need for private capital is going to be quite high, and we are seeing the beginnings of the need for gap capital to help refinance maturities that are starting to become topical next year and the year after.
Joining us now, we have Brian Rehling of Wells Fargo and Stephen O of PineBridge Investments. And Stephen, I'll start with you on that point. Is a rise in defaults inevitable?
Well, the rise is inevitable, but I think you have to put things in context. You're
rising from ultra low levels to what I would still consider to be very moderate levels. Keep in mind that for the past couple of years, we've been running at default rates, for example, in leveraged loans at 1% or lower, and relative to historical averages about 3%. So I think going up from those ultra low levels up toward historical norms are far from conditions that one should be, frightened of.
And Brian, when you think about what we're seeing in this market, what's priced in, and you look at spreads staying near the tightest levels in quite some time, how are you thinking about valuations in this market versus fundamentals?
I mean, to me, valuations are expensive. I know there's a narrative out there in the market that we're going to get soft landing, everything might turn out okay. But I mean, the odds and history suggest that that's probably not the most likely case. I just don't see the advantages here of buying high yield, lower credit quality at what are some extremely tight levels. It just, this late in the cycle, it doesn't seem like a good value to me.
And Stephen, come in on that point, because valuations, you can make the case a number of different ways that they're very stretched right now. But how are you thinking about that relative to the economic backdrop and the health of corporate America?
And you hit a really critical point. Valuations should not be looked at in isolation, but in relation to what type of economic environment that we're heading into, what type of corporate earnings environment we're heading into. And I think we can argue degrees, but we're clearly in a decelerating environment in that regard. So within that context, I think it's fair to say that valuations are far from cheap. But I think where valuations are exceedingly attractive is most portfolio holders are not investing solely in fixed income or solely in credit. And when you look at where high yields are at mid 8%, loan yields north of 10%, as a de-risking valuation allocation from equities and value equities in particular, we believe it's an extremely attractive valuation to de-risk your portfolio at those types of yields. And when you look at measures like, the equity risk premium, all points really are in context to where other things are, where other parts of your portfolio are. And in that context, it's not expensive.
Stephen, it's a great point that money managers aren't investing in isolation. And actually, the equity risk premium is exactly where I wanted to go, because I was reading a note from Barclays this morning. It was really interesting. Here's what they had to say. While the S&P 500 equity risk premium was already low for most of 2023, the latest leg of the rally has caused the ERP to fall below IG credit spreads, raising the question of whether equity investors are willing to continue chasing growth at any cost. We doubt the valuation expansion can continue driving upside from here. And Brian, when you put that together and you think of these two asset classes in relation to each other, what's your read here? Is it the credit market that's mispriced, or is it equities?
Well, I think it's both in a way. I mean, I think risk assets are overpriced here, whether it's equities or kind of the lowest credit quality of fixed income. Now, that doesn't mean most investors shouldn't have some mix of those in their portfolios, but I just don't see in either of those asset classes a tremendous amount of upside from current levels. Again, given what we anticipate happening to the economy later this year and into next year, I think earnings are going to be further challenged. I think the economy is going to be further challenged. So I would be a little bit more defensive overall in my positioning, but absolutely, depending on the investor's objectives, most of these asset classes are going to have a significant portion of in their portfolio.
Well, to that point, the expectations for what's going to happen to the economy as we get closer to 2024. Stephen, if you rewind back to that sound that we played from Armen Panosian, that was in response to a question I asked him. Would a recession or sustainably higher interest rates from here be worse for corporate bonds? What's your take?
Oh, in my mind, it's absolutely a recession in the near term, because that drives, it's a circular loop, right? The economic conditions would drive spread issue, demand for credit, even though higher interest rates does infringe on the cash flows of a company. Keep in mind that companies don't fail because their interest burdens have increased. Companies fail based on liquidity conditions, whether it's directly from capital markets, suppliers, and so forth. And so the recession is going to determine, and the severity of that would determine the liquidity conditions and credit availability conditions, which then filters into the negative outcome. And furthermore, higher interest rates are usually symptomatic of a stronger than anticipated economy. And that would indicate that the underlying corporate earnings is better. And so that would offset the rising interest rates.
Well, Brian, with the minute we have left, I'll ask you the same question. When you think about the corporate bond market, what's the bigger pain point? Would it be an economic downturn, or would it be higher for longer?
Yeah, I mean, there's no question it'd be an economic downturn. I do think the higher for longer is eventually going to cause that economic downturn. But yeah, there's no question that a deteriorating economy is really what's going to hit these risk assets the hardest.
All right, guys, really enjoyed this conversation. Appreciate your time on a Friday afternoon. That is Brian Rehling and Stephen O. Thank you both so much. And of course, speaking of credit, in about 20 minutes right here on Bloomberg Television, Blue Owl co-CEO Mark Lipschultz will be joining us. That's at about 1:40 p.m. New York time, so don't go anywhere. And still ahead on Real Yield, it's the final spread, the week ahead, key inflation data on deck. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up Tuesday, is Apple's iPhone 15 launch event, and then we'll get US CPI on Wednesday ahead of PPI, and then a decision from the European Central Bank on Thursday. Friday brings University of Michigan sentiment and then Chinese economic data. But it's probably those U.S. inflation figures that are the ones to watch. If you take a look at what we're expecting, you can see that both on a year-over-year and a month-over-month basis, expecting to see a bit of an uptick. Not the case if you look at those core figures, both year-over-year and month-over-month expected to hold steady. Whether this is a game changer for the Fed when they meet the following week remains to be seen. But from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.